It's Brian Preston, the money guy.
You came up with the 3 S's.
Yeah, if you want to prepare for the next downturn, if you want to make sure that no matter what the market does over the next 6, 12, 24, 36, 48, 60, 120, 240, however many months you're talking about, we think that there are 3 S's you can sort of hone in on. And if you can master these 3 S's, you're going to set yourself up for long-term success. And the first one might be surprising to hear from folks talking about a market at an all-time high, but it's safety. The first S is safety.
Well, I think all of us, we go through life, and you first need to have a strong foundation to your financial life so that any type of financial emergency that comes your way doesn't put you in the ditch. Because when you're in a bad pickle of a situation, you don't always think rationally.
That's right.
And you can turn a little $1,000, $2,000 mistake can turn into something that haunts you for the rest of your life. And then you never recover from that one hiccup. So that's why we first focus on safety by looking at risk management. And when we talk about risk management, we're primarily talking about, do you have enough cash reserves to make it through what may come your way? Now, look, I'm sitting here with my, laminated 9 steps of the financial order of operations. If you want to go check this out, just go to moneyguy.com/resources, and you too can download this for free. But step number 1 is deductibles covered. This is because your biggest risk are those things that you typically buy insurance. We're talking about health insurance. We're talking about your auto insurance. We're talking about your homeowner's insurance. Go figure out what your highest deductible is between all of your different insurance providers. Whatever that number is, save it up, and that's going to be your first stop in making sure you have enough cash to keep your financial life out of the ditch.
That's exactly right. And then as you continue to progress along in the financial order of operations, you're eventually going to get to emergency reserves. You're going to get to step 4, and what you have to do there is you have to make sure that the emergency cash you have on hand matches where you are in your financial life cycle. Are you someone who needs 3 months of emergency reserves? Are you someone who needs 6 months of emergency reserves? Are you someone who's approaching financial independence and your emergency reserve should actually be somewhere between 12 to 36 months of living expenses? If you want to be prepared for the next downturn and not have to make very difficult decisions when the market is at a point where you don't want to make difficult decisions, cash is going to be that buffer that allows you to weather that pending storm.
Yeah, I mean, here's another little truth of financial planning. Who gets more nervous? The $300,000 client or the $3 million client? And now you're like, well, of course, the $300,000 because the fat daddy over here with $3 million doesn't have to worry about. But the reality is a lot of times it's not the size. There's enough margin to get through. It's the cash. And because that person who has $300,000, a market goes down 10%, they're probably getting it, they're cutting to the bone. Whereas the $3 million. So that's why we are trying to make sure when we're talking about safety, yes, you don't have the $3 million yet, but you ought to at least go ahead and give respect to the margin of cash reserves so that you don't have to panic, don't have to make a bad mistake that hurts you financially like a small investor would, because that's where you get in trouble. And we want you to reach that critical mass faster by already accounting for it. Because I think a lot of people think, hey, I'll go get every dollar working for me because I'm going to get to $3 million faster by having 99.5% of my money working for me versus 96 or 95% working. That's a mistake, guys, so don't fall into that trap.
Another thing you want to make sure you do when it comes to safety is you want to make sure that you have the appropriate coverages in place, because what happens when the market turns down, what happens when the market freaks out, is it takes an emotional toll on us. No matter who we are, even financial mutants, when it gets really, really bad, it becomes uncomfortable. And what happens is all the other parts of your financial life start to weigh on the decisions you make financially. Brian, we've talked about this before. We have a dear client back in 2008 who she made a decision that we tried to convince her not to, but she said, hey guys, look, I understand the financial part of it, but I have all these other stresses. I have a health stress, and I have a family stress, and I have a medical stress, and all these other things. I have to make this decision because of that. Well, if you can inoculate yourself from as much risk as possible by having the appropriate estate documents in place and insurance policies in place, whether it be health insurance or disability insurance, you can make sure that when the burden and stress of financial uncertainty comes, just like Forrest Gump says, those things are just one less thing, one less thing, one less thing.
And we deal with this. I think one of the things I feel like the financial world gets wrong is that we focus on risk tolerance, which is how much of a cowboy or cowgirl you are, and the fact that if things get scary, how much risk do you want to take to make your money? That's only half the equation.
Right.
Your risk tolerance on how much volatility you can handle before you cry uncle is just a little bit of the risk profile. The other part is risk capacity.
That's exactly right.
And this is what you're kind of alluding to, Bo, is that we also have to take into account not how much we can handle on the volatility, but also where we are in our goal seeking, where we are in our age, because there will come a point where you've won the game, where you don't need to be taking more risks. There's a reason, guys, when you say, Brian, why don't you want me paying down my mortgage until I'm over 45? That's because, guys, you're approaching that stage where risk, definitely of taking too much, chances and too many things that could, jeopardize your financial empire, that comes into play. When you're under 45, it's much more powerful to let your army of dollar bills grow. That's risk capacity that we're talking about when I'm taking into account where you are in your walk towards financial independence. And we even, let me put this, we actually put some graphics with this. I'm thinking about a 70-year-old who's still working in great health, and they're like, look, I've built wealth because I've always been comfortable with taking risk. We deal with this all the time with small business owners, real estate investors. They think they can handle anything that comes their way. And we're always trying to explain to them, hey, you're in your 60s, you're in your 70s. It's no longer time to risk it. And I'd even go, this could work on people in their 50s too. You need to be minimizing, because they think about it in terms of, I don't want to miss out on that 40% rate of return.
That's right.
But here's the thing. If you lose 40% in the markets, you have to make 67% to get your money back.
That's just
cool
clean math. Clean mathematics.
This is the fun. Because here's what's crazy to me. If you lose 50%, you have to make 100% to get it back. If you lose 10%, you only need to make 11% to get you back to where you started. This is a cool thing about mathematics, but we went a step further. We said, okay, let's assume a basic like 60-40 type asset allocation that can make 9% a year. How long would it take to get that money back? You can see if you lost 10%, it's only going to take you 1.2 years to get right back to where you are, where you're making money, you're in the green again. You lose 40%. And believe me, we saw 60 and 70-year-olds in 2008 who, for some reason, still were doing all tech. They weren't even just doing the S&P 500. They were doing all the technology and information type mutual funds and so forth, because their 401k, that was the best performing asset class of the last decade. They'd lose 40%. They'd have to make back 67. It would take them 7.4 years. Imagine if you're trying to retire. You're 62 years old. You know you're retiring in 3 years. And you know it's going to take 7.4 years just to get back to break even. Not even taking into account the opportunity costs those are years that you're not going to be growing your assets. It gets really scary.
While you may have the tolerance for that kind of loss, you do not have the capacity for that kind of loss. You will, all of us will, reach a point in our financial journey where it's no longer about how much money do I make, how big are my returns. It's about how much do I get to keep over the long term.